Welcome to the TFN 60-Second Buzz. I'm Andrew Mickey. Over the past 2 months, we've been getting nothing but bearish signals from the retail sector. But it wasn't only until the past week that we finally saw some top retail stocks start to take a dive. And there's one that's going to fall faster and harder than all the rest. In March, total U.S. retail sales increased a meager 1.1%. Wall Street spinmeisters blamed the weak sales reports for March on the timing of Easter. And Target's CEO offered encouragement that there's nothing to worry about. Things will pick back up in April. What a load of garbage. But the excuses did successfully buy a little extra time for the retail sector. But in the end, they were just delaying the inevitable. When April sales figures were released last week, there was no making excuses this time. April retail sales declined 0.2% nationwide, well below the analyst community's consensus forecast of 0.4%. And this time, no one was blaming weaker than expected Arbor Day and Earth Day sales. With no scapegoats handy, it was time for a bit of honesty from the leading retailers. Even Walmart CEO Lee Scott got in on the action when he proclaimed this week, "Quite honestly, we're not satisfied with our overall performance." And what's Walmart's proposed solution? To cut prices? Is this the kind of plan shareholders pay Mr. Scott $1.3 million a year to come up with? Can stuff get any cheaper at Walmart? Regardless of whether this move is wise or not, Walmart's decision to cut prices isn't good for the rest of the major retailers. But that's just the tip of the iceberg. This summer won't be good for retailers at all. Is it high gas prices? Or maybe even declining housing prices? Maybe it's just the easy money credit pool is finally starting to dry up. Heck, it's probably a little bit of all three. But we know the retail sector is headed for a fall, and the American consumer will be taking the summer off. Leading discount retailers like Walmart and Target should be able to weather the storm, although they're far from good-looking buys right now. However, all this news doesn't bode well for shares of Coach Inc., ticker COH on the NYSE. Over the past 5 years, Coach has been one of the great Wall Street success stories. They've opened stores at a record rate and have grown earnings at an annualized rate of 49%. And the whole time, consumers couldn't get enough of their $500 handbags and $300 laptop cases. Now that's all about to change, and Coach is set to go Krispy Kreme on us. For years, the leather retailer has expanded rapidly and could do no wrong. And top institutions including American Century, TIAA-CREF, UBS, and Barclays have all loaded up on shares. However, since February 2nd, Coach executives have been running for the exits. In fact, they've managed to dump more than 758,000 shares from their personal holdings and bank a cool $37 million in cash in the process. Coach's CEO alone has cashed in more than $27 million in company stock over the past 3 months. And when a company CEO is unwilling to stand behind his own company stock, there can't be much good around the corner. Meanwhile, Coach continued its record run from $5 all the way up to $54. Completely unsustainable. The Level 6 trader system has already identified almost non-existent institutional interest in Coach shares and aggressive selling from institutional investors. And now, with no smart money to cover Coach's overinflated $17 billion market cap, it's time to get out of this stock now. Don't get caught up owning shares of Coach this summer. The selling frenzy has only just begun. The insiders know it too, and have already cashed in their chips. On top of that, Coach shares haven't had a good June since 2004. But this time, we've got the makings of something much worse. I'm not saying Coach is a poor company. It's not. The big problem is shares have just climbed too far, too fast. And this is a $35 to $40 stock if I ever saw one. Buy some August expiration put options and enjoy the ride. For TFN's 60-Second Buzz, I'm Andrew Mickey.